Okay, so in this video, I'm going to run through long and short positions in currencies. So let's start with the following situation. Say you have two bank accounts in different currencies. And for this example, we're just going to say we have one in US dollars and one in euros. And they both start off empty. And say, for example, the current rate for euro dollar is 1.3. So what you could do, you could withdraw $130 from your US dollar based account, convert it to euros via the euro dollar exchange rate, and then place that 100 euros into your euro bank account. So now basically you're overdrawn in your US dollar account and you have some euros in your euro account. So for the purpose of this video, we're just going to ignore overdraft fees and interest rates and so on. It turns out, in the interbank market, there'll be obviously you'll pay interest on cash you hold in an account, and you'll be paid interest on cash you hold in an account, and you have to pay interest on an overdrawn account. And the amount of profit you make there depends on the differential between those two accounts. If you were to do this using just consumer banking, retail banking, obviously the rates for being withdrawn are a lot higher than the interest paid on an account. But actually, if you're professional, that's not necessarily the case, and you can make profit from a rate differential. We're going to ignore that fact for this video and just consider your exposure to the exchange rate. Okay, so this is our position. We're overdrawn $130 in our US dollar account, and we have 100 euros in our euro account. So let's say, for example, euro dollar goes up by 1 cent, so it moves up to 131, which is about 0.8%. And so what we can do now, we have 100 euros in our account. We can sell that on the market and get $131 for it. So if we're going to put those back into our account, what we'll find is we've now cleared our balance in the euro account, and we're left with $1 profit in the US dollar account. And let's consider a similar situation where euro dollar goes down. So say it goes down by 1 cent to 1.29. You can now sell these 100 euros you have, but you'd only get $129 for them. So if you put these values back into your account, you'll be left overdrawn $1 in your US dollar account, so you've lost $1 there. So that's what it means to be long a currency pair. So we're in a position now where we make money if euro dollar goes up, and we lose money if euro dollar goes down. So we're basically making money if the euro strengthens relative to the US dollar. And one other way you could say this is you are long euros and short dollars. So we're long the traded symbol euro dollar, but what we really are is we're long one currency and short another. That's always the way if you're trading currency pairs. You're long a currency, but it has to be with respect to a different one. Okay, so let's consider a short position, which is very similar. So you have your two empty bank accounts, and let's say euro dollar is once again 1.3. And in this case, we withdraw 100 euros and we convert it to US dollars at the exchange rate of 130 euro dollar. So we take $130 from the trade and put it into our US dollar based account. So this is the bank account position. And let's say, for example, euro dollar goes up by 1 cent again, which is about 0.8%. So if this is the situation, we now have to pay $131 to get back these 100 euros we sold. So what that means is we're going to be left overdrawn $1 in our US dollar account. And let's look at the other situation where the euro dollar goes down. So we're going down to 129 again. And in this case, you only have to pay back $129 to get your 100 euros, which means we have $1 profit. So this is a short position. So this is the position where we make money if euro dollar goes down, and we lose money if euro dollar goes up. So we're short the 6-letter symbol euro dollar. So in this situation, we're making money if the euro weakens relative to the US dollar. And we can also say we're short euros and long dollars if we're talking about the individual currencies. And one could say that this is equivalent to being long dollar euro, which doesn't trade, doesn't really exist. But if it did, a short position in euro dollar is equivalent to a long position in dollar euro, and vice versa. A long position in euro dollar is equivalent to a short position in dollar euro.